Good morning, everyone. I am A.F. Thornton, Chief Investment Officer of Blueprint Quantitative Strategies. New here to YouTube. We've had a YouTube channel for a few years, but never used it until the last few weeks. And why not, in this crazy time we're in, why not get up here and give out a few opinions? But the true intention of the channel is to help you learn how to invest and trade. That's what we're here to do. And in that regard, just I'll show some precatory language in a minute, but basically, I think you're smart enough to know not to take your advice from some YouTuber. So these videos are intended for educational purposes only. Don't rely on them. Don't trade based on them. Just use them as a reference point to learn how all of this works. And if you do that, you'll end up in a good place. So with that out of the way, I swear, I think if we look back in history, what we're going to call this is the Ripley's Believe It or Not period of the opening of the 21st century. So and maybe we should do a Ripley's Believe It or Not every day, but today's Ripley's Believe It or Not is, since we're now in what used to be the technical definition of a recession, or certainly the definition of a recession if the Republicans were in charge, or I don't know what we're in now. We've had some, why don't we call it just a slowdown in growth? The growth has just slowed down a little bit because yesterday we changed the definition of a recession to help the Orwell administration get through this and perhaps do a little bit better in the November elections. In fact, they were publishing some great polls yesterday, some good fake polls to lead the November midterms, telling us that the Democrats were at least favored by 4 points in the midterm elections yesterday because of the abortion issue. Apparently, most of the country is so excited about abortion that they want to reelect the Democrats now, even though they've run the country into the ground, along with their Republican friends. So take it for what it's worth. But the new definition of a recession, and being an attorney by background, I can explain to you that what you're looking at is a red line here. So what it says is, while national definitions vary, 2 consecutive quarters of decline in a country's real gross domestic product is commonly used as the definition of recession. That was the definition up till the Orwell administration had a recession reported yesterday. Now, the new definition is there is commonly no global consensus on the definition of a recession. Is that a definition? I'm not sure. But basically it's a little bit like climate change. It's something that you can't prove or disprove now. So a recession's the same thing. We're not in a recession. Nope. 2 consecutive quarters of a decline is not a recession. And probably the only thing I'll give them is that unemployment is low right now. But we're just starting the recession. My figures show me it started in May, and that being the case, believe me, what things are going to look like when this recession is over is enough to make your head spin. And quite frankly, it's probably going to morph into a depression. Maybe they'll get ahead of that and change that definition too. Last year we changed the definition of a vaccine. So that was pretty cool, right? Vaccines used to cure things, but now they just, they're different. So here we are. We're not in a recession, no matter what anybody tells you. Look over here, look over there, but don't look here. This isn't a recession. And it's just mind-boggling. It's mind-boggling. President Orwell and the rest of his administration just, no matter, they just tell you the way things are. No matter what you see, they'll tell you what it is. So welcome to 1984, as it were. Anyway, let's get past that and get into this crazy market, which is defying the laws of gravity in and of itself. And Let's start over here with the weekly chart. Actually, let's start with the chart we've been working on for the last week and a half, 2 weeks. X marks the spot, right? And here's X. And like I said in the blog yesterday over at blueprinttrading.com, don't put the E in blueprint, just BLU. But at our website, blueprinttrading.com, it's like a cactus needle stabbed through the X yesterday. So what was X? X was the grand central station of resistance. And those types of areas act as magnets. We've been looking at that as our target ever since we hit the June 17th low here. Let me see if my highlighter's working. Of course not. Oh, whoops. No, it's Alt-H. All right. Nope. That just gave me a line. So let's go over here, see if we can make it work. Because I know sometimes it's hard to see my cursor. Because there's a few errors there. Let's see now. There we go. So ever since the June 17th low, and this is a 40-week cycle low, very important intermediate cycle in the year, in a given year of trading. And we said that this would probably lead to a stronger rally than we've seen in some of these others. And that's certainly the case here, although it gave us a few willies along the way, but we finally stabbed through that yesterday. So I said when we got to this level, I'd reevaluate, because we're reconnecting with the monthly 5 EMA. This is also the weekly 21, or the weekly mean, and it is also the 89-day line. These are all important lines, especially in a bear market. And I'm going to focus in a minute on the 89-week line, because I think that's a kind of a threshold. But in any event, we've now reached this level. It's a high volume node, and certainly connected with the lows that we see over here. And actually overnight, Apple and Amazon, their reports yesterday were interpreted positively by the market. I don't even care what they say in the reports, but they were interpreted positively because the market wants to go up. So here we sit now. This is where we broke down out of the topping pattern that we formed earlier this year. And the question is, how much further can we go? And I guess two observations. One is that this is a 40-week cycle from this point to this point. So from last October to where we are now is a 40-week cycle completed. And it's a nominal 40-week cycle, meaning that's what we name it. It actually has been running less than 40 weeks, about 33, 34 weeks, somewhere in there. And that half cycle is a 20-week, which we saw over here. So as we saw even on the 20-week low here, we got a much more aggressive rally than we see on some of these minor cycle lows. And that's what's going on now. This is, I call it, this is a money management business rally. That's what this is, okay? And what I mean by that is, you know, some people are even calling it the most hated rally ever. Nobody wants to buy this, given all the things on the table. But money managers are forced to buy it, because when we're sitting down here, they have the highest cash position since 2009. A lot of hedge funds have underperformed anyway for the year. And I often say, because I had my own hedge fund when I was younger, and I owned a bank and a trust company and a family of mutual funds, and this is back in the late 90s, the money management business really sucks, because basically it's all about your relative performance. Clients are fickle, especially institutional clients. So when you underperform your peers, you lose a lot of business. And so money managers operate, I think, more on FOMO than anything else. I remember our attorneys telling us that you can lose money as long as you lose a little bit less than your peers, but the most unforgivable sin in money management is to be in cash when the market takes off without you. And that phenomenon is occurring right now. Now, every low, every important low, every rally starts with something. It can start with short covering. And it could start with money manager FOMO. I mean, I think we already saw a lot of the short covering here. So this is a lot of money manager FOMO, and it's a powerful, powerful thing. And who knows how high that can take us. Maybe we stop here. Maybe, I mean, we did tag 4,100 overnight. We may go up and see these, this area here, the middle, that's about 4,133, and could even take us as high as 4,200. And you'll see that even on this 20-week cycle low, we took out the same levels that we're identifying here. We took out the monthly 5, the weekly 21, and that, but that still ended up in a fake out. We took a precipitous decline from that point, and you know, if this is going to continue to be a secular bear market, something like that is going to happen here. So you can see a very high volume node up here around 43.50. That would be quite the prayer if we got up there, but it's possible, guys, when all this, you know, you're already in summer trading. Liquidity is low here. So when liquidity is low, you can drive prices a lot higher with demand, and that may happen. So it's theoretically possible we could get up here. The 50% retracement of this entire decline sits up around 4,200. We've got this highs around 4,200. We've already retraced most of this. So if we, I mean, there is precedent to go higher. It's possible. Up to maybe this 4180 area we talked about earlier this week, you know, I might be inclined to take some more long positions, but we're getting kind of long in the tooth here, as it were, and I think you've got to let this thing sort of settle in. It's possible we'll come up to this high and then come back down again and form a right shoulder, even if this is some kind of an important low. So, I mean, it is an important low, but I don't know if it's the low, and only time will tell. I mean, you know, the stock market isn't connected to fundamentals anymore anyway. It's not about earning. It's not about price earnings ratios. It's overvalued by any measure. This is just about, it's become a tool of Fed policy and central planning. And I don't know what else you can say about it. It's kind of discouraging in this Ripley's Believe It or Not era. So we'll see what it does here. In the meantime, we have moved outside the weekly expected move range, just as we did last week, and it's quite possible, probably 70% probable, that the market is going to pull back into that range by the close today, so that the market makers and dealers don't get their head handed to them. The daily expected move range would allow for a move up to right around 41 and a quarter or so, which could happen intraday, and then, you know, we could go a little bit higher this morning and then bring it back into range. I'm noticing up on the left here that my the market's headed back down already to 40.88. So more than likely we've got the PCE index inflation report. Let me just take a quick peek and see what happened on that. But my guess is that that did not come out too well, because that's often what happens. And let's see what it's saying. It's a consumer spending report, little higher than expected. Now remember, good news is bad news is good news at this point in time. I don't see the PC price index report yet. Let me just refresh here just in case. Oh, it did come out. So it came out at 6.8%, which is in line with expectations, but still a little bit higher than what people were expecting. The core PCE did come in higher at 4.8 versus 4.7. Core PCE price index 0.6. So inflation is still running strong, and this apparently is Chairman Powell's favorite indicator for inflation, which I don't understand, because what a bunch of people, average people, think about the future of inflation wouldn't be very important to me, but nevertheless, if it's important to him, I guess it should be important to us. So perhaps not the best of news on the inflation front. That may, again, take us back into range here. So more than, 70% probability we're going to close at less than 40.70 before the close today, and that would be consistent with the expected move for this week, and certainly work off a little. We've had a couple of pretty strong days here, so that would help work that off. Now, I guess the only other thing I'd say about where we are in this rally is we're not seeing, the kind of breadth thrust or other things that we would like to see to really confirm that this is, a great rally, but nothing's perfect at this point. So anything is still possible. We reached our X marks the spot. I said I would reevaluate. And so here's my conclusion. We could go a little bit higher, perhaps as high as 4,200, but it's really a prove it to me mode now, especially because at least at this point in the week, we're in the red zone for taking long trades. Now, should we take some short trades? I mean, you can do it intraday, but I don't think there's enough evidence on the table to say, the short-term trend is up. I'd like to see a little bit more confirmation of the downside before I took a short trade. So let me wrap it up there for today. It's Friday. I don't always trade on Fridays. It depends on what the options market is doing. Sometimes you can get pinned around a level. We know that 4,000 has been the biggest gamma level. We got through that. So yesterday we took some great trades. We have worked every single one of these rallies, whether in the trading room or with our swing positions and options. So go over the website and check that out at blueprinttrading.com. Again, don't put the E in, and you can kind of see what we've been doing, whether it's in the trading room on Tuesdays and Thursdays or just in the swing positions. So it's been a great run for us. Glad we finally hit X. Definitely excited about that. Not sure how much higher we can go here in the short term before we start testing the downside again. Maybe a little bit higher, maybe as high as 4180 to 4200. So let's leave it there for now, and I'm taking the rest of the day off. I'm going to go sip margaritas on the beach. And have a great day. Have a great trading day. Have a great weekend. I'll be back live Sunday night to update everything I see over the weekend. So have a great weekend, and I'll be back soon. Bye-bye.